we should see the core CPI go down in the future. So this was really good news, and it actually helped the stock market rebound a little bit on Wednesday. Hi guys, it's Stock Curry, and the stock market rebounded off of Tuesday's lows and rose a little bit on Wednesday on some good inflation data. There are still some things that we're going to have to watch out for though, and I'll let you know what those are in today's video. So let's get into it! After the CPI inflation data came out on Tuesday worse than expected, there were some fears that the PPI, or Producer Price Index, which is a gauge of prices at the wholesale level, would also rise in August. And luckily, it actually fell. It fell 0.1% in August, which was in line with the original expectations. Now, the PPI, or Producer Price Index, is an early indication about where the CPI, or Consumer Price Index, might be in the future. And the reason for that is because whatever wholesalers pay for the price of goods that they produce, that ultimately gets reflected in what the price consumers pay in a month or 2 or 3 months down the road. So long as the PPI continues to go down, we should see the core CPI go down in the future. So this was really good news, and it actually helped the stock market rebound a little bit on Wednesday. Now, it can be very easy during times like this to start getting bullish again and think that this might be a good time to buy the dip, especially if you are under the assumption that stocks always go up and that you should always buy the dip. Unfortunately, it's very important that we have a neutral mindset and that we not be 100% bullish all the time. We have to understand that while buying stocks today and buying the dip today will most likely lead to us being up 10 or 15 years down the road, you might not want to wait that long to actually see your portfolio turn around and go up. During the dot-com bubble in 2000, it took almost 15 years for stocks to break even. Not for stocks to go up, for stocks to break even. And I don't know about you, but I don't want to wait 15 years for my portfolio to break even. I want to make money now. So the best thing to do right now might not be to buy the dip, but rather the best thing to do right now might be just to hold on to some cash and wait for stocks to continue going lower. Now, nobody can time the market. Nobody knows where the bottom is. But what we can do is we can look at the fundamentals. We can look at where the economy stands right now, and we can get a pretty good gauge to whether stocks should continue going lower or whether stocks should continue going higher. And right now, the market sentiment is for the stock market to continue going lower because the fundamentals of the economy point to things getting worse, not better. Once the fundamentals of the economy point to things getting better, that is when we should be near a bottom. Now, nobody will be able to time that bottom perfectly. We might be off by a month or two, but we should have a general gauge of when the market sentiment is going to turn around, and that will happen when the economic fundamental outlook turns around. And if you're wondering when we will know when the economic fundamental outlook will turn around, it's when the Fed starts to lower interest rates and when they stop raising interest rates. So long as the Fed continues to raise interest rates, that will continue to put downward pressure on the stock market. As soon as the Fed turns around and starts to lower interest rates, that is going to put significant upward pressure on the stock market, and that is when it will be time to start loading up on stocks again. So how will this lower PPI number affect the Fed? Will this cause the Fed to slow down the rate of interest rates? Well, unfortunately, no, because the Fed is not concerned about one particular data point. They're looking for data over time. They're looking for inflation to come down over time. Keep in mind that the CPI, the Consumer Price Index, was up. So we have not yet seen inflation start to come down on any sort of consistent basis. And in fact, the bond market is pricing in a faster than expected rate increase from the Federal Reserve. Short-term bond yields are now topping 3.8%. And don't forget that the Federal Reserve is meeting next week on Tuesday and Wednesday. And on Wednesday next week, they're going to announce how much they're going to raise interest rates by. Now, prior to the CPI print that we got on Tuesday, it was about a 50% chance for a 50 basis point rate hike and about a 50% chance for a 75 basis point rate hike. Now, after the CPI print, there is a 0% chance for a 50 basis point rate hike. There is now a 76% chance for a 75 basis point rate hike, and there's a 24% chance for a full 1% rate hike at the Fed's meeting next week. And as the Fed continues to raise interest rates at a faster and faster pace, this is going to put more and more downward pressure on the stock market. As you can see there, a 75 basis point or 0.75% interest rate increase from the Federal Reserve is priced into the markets right now. If the Fed comes out and does a larger than expected 1% rate increase, that could cause the stock market to go down even more next week. On the flip side, if the Fed comes out and does a 75 basis point rate hike, which is pretty much what's priced in, that could cause the stock market to go up because now the uncertainty is gone away. And of course, if the Fed comes in and does a 50 basis point rate hike, we could see the stock market absolutely skyrocket because a slowdown in the rate of rate increases will be good in the short term. It is unfortunately bad in the long term because it just delays inflation. And this rise in interest rates has also caused mortgage rates to climb to 6% for the first time since 2008. Now, I hate to compare anything in this economy to 2008, but we do have to be very neutral and objective here and accept the facts for what they are. No amount of hope or positivity is going to make our stocks go up. Ultimately, the stocks are going to move based upon the news. And right now, the news is quite negative. So we just have to understand that and find ways to make money as the stock market goes down. I listed quite a few ways to make money as the stock market goes down in my video yesterday, which I'll post here in a little bit. But first, I just want to talk about the mortgage interest rates and how those are actually affected. Because a lot of people think that the mortgage rates are directly affected by the federal funds rate, and they are a little bit, but for the most part, they are affected by something called mortgage-backed securities. Now, a mortgage-backed security is essentially like a bond where when your mortgage is sold, it kind of goes over to like Freddie Mac or Fannie Mae, and they create these things called mortgage-backed securities, and it kind of sets the rate for what the end consumer eventually pays. Now, the rate of the mortgage-backed securities, also known as a yield, has been rising. And the yields rise as the price of those mortgage-backed securities goes down. A little bit complicated, I know. Just understand this, that so long as the price of those mortgage-backed securities goes down, the yields are going to go up, which means the mortgage rates are going to go up. So then the question is, well, what's causing the price of these mortgage-backed securities to go down? And the answer is, once again, the Federal Reserve. You see, as we look at the supply-demand curve, as demand goes down, price goes down to get things into equilibrium. And what has caused a slowdown in demand? Well, it's the Federal Reserve. In 2008, or really 2009, the Federal Reserve did something that they had never done before. They started buying these mortgage-backed securities. You see, prior to 2009, the mortgage-backed securities were run by the general overall market. Whatever the market rate was, that's what you paid for a mortgage rate. But starting in 2009, the Federal Reserve was trying to kickstart the mortgages again. They were trying to kickstart the housing market. So what they did is they did something unprecedented, and they started buying mortgage-backed securities. Now again, that caused demand to go up. And as demand went up, the inverse of that was yields. The yields went down. As yields went down, this caused mortgage rates to go down. And that in turn caused mortgage rates to get very low, and it reinvigorated the demand for mortgages, and in turn the demand for houses. Now, for the first time in a long time, the Fed is starting to sell off those mortgage-backed securities they bought, and that is causing demand to go down, which in turn is causing yields to go up and rates to go up. This, of course, is going to have the effect of causing demand for homes to go down. Eventually, home prices will start coming down as well, and in fact, we're already seeing that. And we have to understand that right now, rates are as high as they were in 2008. So we could see another decline in housing rates. We could see another decline in housing prices. We could see another housing collapse, another housing crisis. We have to understand that this is a possibility, and we have to be prepared for it. So again, not the time to go load up on stocks. We have to understand the fundamentals of the market are still bearish and negative. Great time just to wait, hold your cash, and wait for the fundamentals of the economy to turn around and to turn positive again before we start loading up on stocks. Now, shorter term, we have a bigger issue that we need to watch out for. Yesterday, I talked about a possible U.S. railroad strike, and you have to understand that this could fuel inflation. It could cause inflation to start going back up again. And the reason for that is that 40% of all goods are sent by train. If the railroad shut down due to a strike, that could cause 40% of all goods to stop being moved. And that will cause a significant supply chain disruption, which will in turn lead to high inflation because demand will remain the same, but supply will drop off significantly. And when there's more demand than there is supply, prices go up. Now, the railroads have until Friday to work out a deal, so we still have a little bit of time before they actually strike. But if they do strike, we can expect inflation to start going up again, and we can expect the September CPI inflation data to be much higher than what's currently being expected. Of course, that data won't come out until next month, but all of it could be factored in to what the Fed decides to do as far as how much they decide to raise interest rates by, and ultimately this is going to factor into how much the stock market goes up or down in the short term at least. Now, if you're wondering where you might be able to start loading up on some cash so you can buy these stocks at great values in the future, I'd recommend putting your cash into Moomoo right now, because if you deposit at least $2,000 into Moomoo, you will get 13 free stocks. It's free money just for putting your cash into Moomoo and letting it sit while you wait for stocks to finish bottoming out. And if you don't have $2,000 and you still want to get some free stocks, if you deposit at least $100 into Moomoo, they're still going to give you 10 free stocks. Again, it's free money. Don't leave free money on the table. If you're interested in getting those free stocks, you can sign up using my link in the description below. You can sign up at stockcurry.vip/Moomoo. That's stockcurry.vip/Moomoo. Alright, I hope you enjoyed this video and got a lot out of it. If you missed my video yesterday where I lay out all of the fundamental analysis for the economy and show you exactly where we stand, including the railroad workers strike, as well as show you how to profit and make a ton of money as the stock market goes down, make sure you watch the video that I uploaded yesterday. I'll put it up here for you. And make sure you go watch that video so that you know how to make money as the stock market goes down. Don't forget to hit the like button and subscribe, and I will see you tomorrow.